Every mutual fund investor wants a fund which gives him maximum returns with minimal of risk. And for that, we have this category of funds. Yes, the mid-cap category. Mid-cap funds can provide better returns than large-cap funds with a little more risk, but are still less riskier than the small-cap funds. So in today's video, we'll do a detailed review of one mid-cap fund, that is SBI Magnum Mid-Cap Fund. This fund comes from one of the largest fund houses in India, the SBI Fund House. In the course of the video, we'll look at the basic details of the fund, different type of returns and risk parameters of the fund, and also check its risk rating graph, as well as funds capture ratios. And in the end, we will conclude whether we should invest in this fund, or if we are already invested, then should we continue our investment or should exit this fund now. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. To start with, we all know that SBI Magnum Midcap Fund is a good performing fund in its category, that is midcap category. Here, we will be taking into consideration data of direct plans only. Firstly, let's look at the basic details like AUM, that is total asset under management, which is around 8,730 crores, which is not that high for a midcap fund. While the expense ratio is 0.97%, that is around 1%, and is quite higher as compared to other schemes in the category. One thing I have observed that most of the schemes of SBI Fund House are having a higher expense ratio as compared to its peers. This higher expense ratio could be one of the reasons that MF agents and distributors get one of the highest commissions from the SBI schemes. Not going into that topic, let's see the benchmark index. That is, the reference against which the scheme is compared is Nifty Midcap 150 TRI. Now let's look at the sector-wise allocation. From the table, it is very clear that the fund has the highest allocation in automobiles, followed by capital goods, finance, services, textiles, and chemicals. And when compared to its benchmark, its allocation is quite different, except for services and chemical sector. Here, I would especially like to mention about the fund's allocation in the textile sector. I have not seen other major funds having such exposure in the textile sector, and also the category average is only 1.85%, whereas the fund is having an exposure of more than 7%. Now let's look at the top holdings and portfolio allocation. Tube Investment of India is the main stock of automobile sector, whereas Cholamandalam Finance is the main stock of financial sector. The Indian Hotels is from the service sector, whereas Page India is the main stock in the textile sector. Schaeffler India and Thermex are the main stocks of the capital goods sector. Here, if you observe, most of the stocks are having PE ratio of above 50, which is on a higher side. Now let's also check the portfolio allocation. On checking the portfolio allocation, it is evident that the mid-cap shares form around 77% of the portfolio, whereas large-cap shares form other 17% of the portfolio, and only 5% is allocated to small-cap shares. With the above allocation, the fund is able to provide a stable return with less risk, as generally large-cap stocks are considered more stable and less volatile. There are in total 58 stocks in the portfolio, with top 10 stocks making 38% of the portfolio. The portfolio PE is 30.86, whereas portfolio PB is 4.76. Both the PE and PB ratios are on the higher side, which generally indicates that the stock in the funds are overvalued. There are other factors also to be considered before concluding whether the stocks are overvalued or not. But broadly, we can assume that the stocks with higher PE are generally overvalued. Before checking the returns of this fund, let's look at the fund manager. Ms. Sohini Andani has been managing the fund since January 2013, that is, since the inception of the fund, and that too quite efficiently, and hope that she continues in future also. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's look at the returns. Firstly, the trailing returns. On comparing the trailing returns for 6 months, 1 year, 3 year, 5 year, 7 year, and 10 year period, it is able to beat its benchmark for all the times in the category for almost all the times. Maybe not with a very high margin, but the fund has been able to outperform for the entire period, which is quite good. Now let's check the calendar returns and see how the fund is consistent in its performance. Here we have the calendar returns from 2014 to 2022, that is 9 years. And the fund is able to beat its benchmark 7 out of 9 years and its category 6 out of 9 years, which indicates that the fund is quite consistent in its performance. Now let's quickly look at the fund's performance for the year 2023 also. Here also, if you observe, the fund's performance has been better than its category and the benchmark for the most of the times in 2023, which is quite good for a fund. Now let's also check the rolling returns. Here we have the rolling returns for the period 1 year, 3 years and 5 years. For 1 year period, the fund is able to beat its benchmark 74% of times, whereas for 3 years period, it is able to beat its benchmark 71% of times. And for 5 years period, it is 95% of times. Surely, this performance is quite good, but not one of the best performance in its category. Hence, it can be concluded that for a longer investment horizon, the fund's performance is quite good, and hence one should have an investment horizon of more than 7 years for a mid-cap fund. Now let's also see how fund performs on risk parameters. Here we compare the parameters with the benchmark index and the category average. First one, the mean returns, that is the average return in a year, which here is 36.19 and is more than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the returns have deviated away from the mean returns, which in this case is 17.15 and is less than the index but more than the category average. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk adjusted returns, which is 1.89, which is more than the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme as compared to the benchmark, which here is 0.91, which is more than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, the value is 5.50, which is more than the category average. Here, higher the value is better. Hence, it can be concluded that the fund is able to generate better returns than its benchmark and the category, but with a higher standard deviation than the category. Now let's also see upside and downside capture ratio. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 104, which indicates that the fund outperformed 4% more than the index during this rise period. Here, higher the value is better. It should always be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 60, which indicates that the fund declined 60% as compared to the index during the fall period. Here, lower the value is better. Here, both the upside and downside capture ratios are good, and it has been observed generally that funds having good ratios perform quite well in long run and are able to generate excellent returns. Now let's see the risk rated graph. Here on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that the fund has a better total returns value with more standard deviation as compared to the category average and the benchmark, which indicates that the fund has been able to generate better returns with more volatility compared to its category and the benchmark. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So coming back to the conclusion, what investors should do. First, the existing investors. The fund's performance has been consistent and marginally better than the index. Hence, if you are content with the performance of the fund, you can continue your investment in this fund. But if you are looking for a higher return, then you can look for other funds, which I would suggest in the coming section. Second, the new investors. They can start new investment as it's a good and consistent performing fund. But keep in mind that its performance is only marginally better than the index. But if you are willing to take more risk, then there are mid-cap funds from Quant Fund House also, which have better mean returns but with a little more volatility into bracket risk. I would like to add that I do not have SBI Magnum mid-cap funds in my portfolio and do not plan to add this fund in my portfolio as I already have other mid-cap funds in my portfolio. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Do check my older videos. Click the attached cards to watch these videos. Thank you.